Welcome, everyone. Today we're going to talk about trading and why it's important to understand the risks involved. Trading can be a great way to make money, but it can also be risky if you don't know what you're doing. That's why it's so important to educate yourself before getting started. Think of trading like a game of chess. You need to have a strategy and be able to anticipate your opponent's moves. In this case, your opponent is the market. The more you know about the market and the risks involved, the better prepared you'll be to make smart decisions and come out on top. Trading is the act of buying and selling financial instruments, such as stocks, bonds, or currencies. Traders aim to profit from the price movements of these instruments by buying low and selling high, or by selling high and buying low. There are different types of trading, including day trading, swing trading, and position trading. Day traders buy and sell securities within a single day, while swing traders hold positions for several days to take advantage of short-term price movements. Position traders hold positions for longer periods, sometimes weeks or months, to take advantage of long-term trends. Trading involves buying and selling assets such as stocks, bonds, and commodities in order to make a profit or hedge against risks. There are many reasons why people trade, including the potential for high returns and the ability to diversify their investments. However, it is important to understand that trading can be risky and that there is always the possibility of losing money. One of the biggest risks associated with trading is market risk, which refers to the potential for losses due to changes in market conditions. Other types of risk include credit risk, which is the risk of default by a counterparty, and operational risk, which is the risk of losses due to errors or failures in systems and processes. It is important for traders to understand these risks and to have a plan in place for managing them. Trading involves various types of risks, including market risk, credit risk, and operational risk. Market risk is the risk of losses due to changes in market conditions, such as fluctuations in stock prices or interest rates. For example, if you invest in a stock and its price drops, you may lose money. Credit risk is the risk of losses due to the failure of a counterparty to fulfill their obligations. For instance, if you lend money to someone and they default on their payments, you may not be able to recover your investment. Operational risk is the risk of losses due to internal failures, such as errors in processing transactions or technology malfunctions. Managing risk is an essential part of successful trading. By taking steps to manage risk, traders can help protect themselves against potential losses and increase their chances of making a profit. One way to manage risk is through diversification. Diversification involves spreading your investments across different assets or markets to reduce the impact of any one investment on your overall portfolio. Another strategy for managing risk is to use stop-loss orders. A stop-loss order is an instruction to sell a security when it reaches a certain price. This can help limit potential losses by automatically selling a security before its value drops too far. In conclusion, trading can be a lucrative activity, but it is important to understand the risks involved. We have discussed the different types of trading and the reasons why people trade, as well as the various types of risk that traders face. It is crucial for traders to manage these risks using strategies such as diversification and stop-loss orders. We cannot stress enough the importance of doing your own research and seeking professional advice before engaging in trading activities. By taking the time to educate yourself and understand the risks involved, you can make informed decisions and minimize your chances of incurring significant losses. Like and subscribe, and we will catch you on the next one.